Good morning, guys. It is Wednesday, May 22nd, 2024. This Bathrobe business. I'm Georgi Oganov. I got the coffee and I got the news. I'm also experimenting with new software. So as you'll see, the layout here is different. So I'm playing with new softwares because I know a lot of you have requested more visual elements, which is totally appropriate. I think there definitely should be. And I've just kind of been dragging my feet getting to it. It's mostly just been the fact that I'm finding a software that I think allows me to do what I want to do. And so I'm trying out this one right now. I don't know if it's going to be the one I stick with, but let's work with it for right now. So I haven't been gone for a week. Like I said, I've kind of been just mostly saving up information for less content so that when I do produce content, it's more quality. But also, it's just been very busy with work. And so it has kind of fallen to the wayside. So this is my first post in almost a week. I think last Thursday was my last post. So let's jump into it. So there's a number of stories I want to talk about. Like I said, I've been compiling them for a week, and I want to analyze a video here that we'll talk about in just a second. I'm going to give you a few stories rapid fire. These are in regards to retail. So retail seems to be suffering, quote unquote, but I've got some information that may contradict that. So Macys had a revenue of 4.85 billion compared to 4.86 billion, which is a revenue miss, right? But it's actually a major turnaround. So as we've talked about, Arkhouse Financial has been trying to do a hostile takeover of Macys, which is something I do not think is a good idea because their whole thing is just come in, sell off the real estate, and salvage the company, like many private equity firms do. So this is actually a good result for Macys because it shows that the tide is turning. So they're downsizing from the number of stores. They're diversifying into Bloomingdale's, and then they have another brand. It's like Blue Mercury or something like that they're using. So only after one quarter, supposedly, they're actually shifting. So it seems like whatever they're doing seems to be working, at least for the short term. So that's just one of my first stories, rapid fire. I'll just hit that real quick. Next story, Lowe's. They did beat earnings and revenue, but it does show that there's less spending going on in the market. This does actually echo what we've seen from Home Depot just a week before. Target also had a disappointing quarter, similar results as other retailers. It shows that there's softness in consumer spending. Now, I'm going to contradict that really quick. So let me test out my snazzy new software. Let's see if this works. One sec. And ta-da. I think that's working. So you should be looking at the Walmart screen. So right now, Walmart is actually beating expectations. So they had a record quarter. And partially it's because of the fact that they have a lot of more higher end consumers. I believe I reported on this last week. So the big question is this a bubble? More than likely it is because Walmart, whenever times seem to be get hard, Walmart has a bubble. And then when the economy starts to do a little bit better, people seem to leave Walmart. So this isn't surprising. I also think this is running in parallel to Target because Target is considered, at least, I think the perception is it's a little bit more high end as far as retail goes. And so I think a lot of the Target shoppers have gone from Target to Walmart. And that's showing this bubble. Now, so Walmart did very well. They had a good quarter, very strong results, and it shows growth. All that is good. In addition, this is the other interesting story, is about shipping containers. So the latest shipping data, and this is just from last week, this is from Friday. The latest shipping data reveals that the mid-range retail is in the new consumer price sweet spot. So shipping is actually going very strongly. If you read this article, it's from CNBC. It talks about the fact that orders are pretty much on track and might even be actually a little bit above what market is anticipating. So the survey suggests the holiday season and the consumer that will likely relatively healthy, as based on U.S. companies import slightly more items during this peak season than last year. So we're actually up on imports. This is also going to help China's GDP, of course. So yeah, even though retail seems to be sagging, overall the economy is actually doing well. I think it's just that the consumer has become a little bit more discretionary in their spending and a little bit more conscientious of inflation, which I think these types of earnings better illustrate inflation than any other a metric like CPI or whatever else you're going off of. It's how consumers are spending their money. The other thing I want to talk about is this article over here. This is another CNBC article, is are consumers pulling back on spending? It depends on which CEO you ask, because there's some sectors that are recording record profit. Well, maybe not record profits, but growth and profit, whereas some are shrinking. Like right now, retail is getting slammed, but Walmart is doing very well. At the same time, like we said, imports are up. Delta Airlines is doing very well. Chipotle is doing very well. So there is a lot of discretionary spending in the market, even though it seems that some sectors are suffering more than others. Now, one thing I think these articles are not talking about is wealth inequality. I think a lot of this does still have to do with wealth inequality. Now, with Walmart, we're seeing a trend where higher end consumers are moving towards, spending less at Walmart. But that just means they have more discretionary spending to spend on other things. Target, I think, illustrates that as well. So I think a lot of these sectors, the way we are seeing sagging, also show a sign of wealth inequality, because even though people that were at Walmart stay at Walmart, the people that have moved to Walmart are now taking their excess money and spending it in other sectors like travel, hospitality, leisure, etc. So I think there is signs of powerful wealth inequality in the economy. I think if you're middle class and above, I think you're doing very well. But if you're below middle class, I think it is much more of a struggle, because the trends in the spending there have stayed consistent. But for higher end consumers, the spending is a little bit more variable. So I think there is strong data to suggest there's a good amount of wealth inequality in the economy that I don't think is easily mended. Next story I want to talk about. As I said, the stories I just talked about, I think, speak more about inflation than any CPI data ever will. And another piece of CPI data is gold. So gold is up again above 2,400. So it was up as high as 2433. I think that was the new record that it hit. This is a record price for gold. So it hit a new record price just a couple of days ago, and it's still above 2,400. That's scary. That's not a good sign. Remember, there's an old adage that gold doesn't actually appreciate in value. Everything else depreciates in value compared to gold. So I think that this is a very bad sign. I think inflation is hotter despite any number that the Fed is going to post, the Labor Department posts. I think it doesn't matter. When you've got appreciating assets like gold like this, I think it's a bad sign for the economy. So at this point, I really don't care what data comes out. I think for the most part, there's powerful inflation in the market. And to further illustrate that, I'd like to share you an article with you guys over here. So this is Larry Summer. So for those of you that don't know who Larry Summer is, that's unfortunate, because whether you like him or not, there's a lot of critique of Larry Summer as an economist. But this guy is the boss of all bosses, the king of all kings. Like, this is the economist's economist. Larry Summer is not a joke. He was head of the Treasury Department, I believe Treasury Department under Bill Clinton. He's been influential throughout multiple administrations. Some partly blame him for the financial crisis. Famously, he was the one that told the Winklevoss twins he doesn't care about their little dating site in the Social Network movie. So this guy is powerful, connected, and incredibly smart. He was one of the first that said, I think he said inflation cannot be transitory when they first started doing stimmy checks and everything else way back when, before anybody else was sounding the alarm, before there was even an inkling of sounding the alarm. He was made fun of, like, oh, old man Larry Summers doesn't get it. So this guy knows what he's talking about. And he just, had an article. This is just from a couple of weeks ago. This, I believe, is in March. This is from Forbes. I don't think that there is. Oh, yeah, March 23rd. Sorry, my microphone's in the way. So March 23rd, this just about a month and a half ago. He talked about how inflation actually reached 18% in 2022 if you use previous government formulas. So remember, inflation calculations are just what do you decide to count, what do you not decide to count. And so the numbers, if you were to run it the way they used to run them back in the 80s, or I should say 70s and 80s, when was the last time we had those record high inflation numbers, when we had crazy high interest rates. During that time period, if we were to use that same formula on today's inflation rate, we would have had 18% inflation. And so that doesn't easily come down. And that's inflation, as we know, is very sticky. So I think Larry Summers' point here is very well taken. And I think it's echoed by the commodities market, because we see here that inflation is actually much hotter than what they've been reporting. That's my rant on gold and inflation itself. Really quick, administration forgives another 7.7 billion in student debt. That's more than 100 for more than 160,000 borrowers. The total debt forgiveness count is up to 167 billion, not a small number. And last thing I would like to talk about is a little video I found on Forbes. Give me 1 second to pull that up. No, I'm sorry, this is on Bloomberg. So this is a BlackRock executive. Who is this guy? Writer, chief investment officer of global financial income at BlackRock. So I'd like to play you guys a couple excerpts about this because let's just play it and then we'll see what happens. So here we go. Let's hope my software is working.
Goods come down. So you think about price of autos on a relative basis. So what's happening for the Fed? Listen, you want to get the average, you want to get inflation down to around the 2% number. Their mandate is price stability. It's not 2. If you're running 2.5, core PCE is now 2.8, but it's pretty stable. We think it'll be pretty stable throughout the year. If you've got a good economy, nominal GDP, so if you take 2.8 of inflation, you get real GDP of 2. You got nominal GDP of 4.5 to 5. Pretty good. I mean, it's a pretty good environment.
Okay, so in that scenario, he's talking about how services are remaining sticky, but goods have come down in price. I have a lot of opinion on that. So he is kind of echoing what I just said a few minutes ago, in the fact that when certain consumers that have more disposable income move into lower tiers of spending, such as going from Target to Walmart, that they have more income to spend on other products, other goods, other services. Now, what he's, I believe, wrong about is services are never going to come down in price. Goods can. And the reason goods can is because it's more about supply chain and your manufacturing capacity. If you manufacture properly, you could get the cost of an individual product down. But services can't, simply because they're based on wages. All service economies are based on wages, and that's why restaurants are famously unprofitable, because wages are incredibly expensive. And once wages have become established as the new norm, as far as inflation goes, they never take a reversal. Wages never come down in price. It's virtually impossible to get that lower without going abroad, without outsourcing, etc. And for most service businesses, that's simply not possible. You can't outsource a waitress here in the United States. You have to use somebody locally on site. So that's my first problem with what he's saying, is he's essentially trying to argue with the fact that we're almost there. We might as well cut interest rates. Let's move to another thing that he said in this video. Give me 1 second. This is the first time I think I've used this software, so I'm still getting the hang of it. Okay, 259.
I'm not certain that raising interest rates actually brings down inflation. In fact, I would lay out an argument that if you cut interest rates, you bring down inflation. Why is that? Exactly to your point. Look at what's happening now. Interest expense is growing, has now eclipsed mortgage payments. Lower income, who much higher percentage of their net worth is in the debt, credit cards, student loans, auto finance, et cetera. What's happened is you've raised the rate, and that has created a real impact. And so, but the other side of it is you actually have an economy, because of this massive transfer from the public sector, from the government to the private sector. People are higher income, middle to higher income, are now getting a big benefit from these interest rates. And that's flowing into, those are the people that spend in aggregate on services. So there's an ironic thing that I've never seen, nobody's ever seen in history. Big transfer of money from the government into the private sector. The private sector now is a creditor versus a debtor in terms of the big.
Okay. So to his point there, I don't know exactly what he's talking about, private sector to public sector shift. I don't know if he's talking about government spending. I'm not exactly sure. But this argument that inflation is actually being caused by interest rates makes no sense. He's talking about lower income. And obviously, we should be striving to help lower income. But the best way to help lower income is to have rents lower, because most lower income will never afford. I shouldn't say never, but it's very difficult for them to afford housing outside of rent. And so if rents are low, which they have been dropping because the market has been arrested from new investment, that's how you keep rates low. So that's the one thing I want to notate as well. Let's move on to his next point. 1 second. Sorry, guys, 1 second. This is the last point, actually.
The benefit of higher rates. So point being, I think the Federal Reserve can get that rate down from 5 3/8. Even if you got it to 4, 4.5, still restrictive relative to a 2.8 core PCE. And it's not clear to me. You've raised rates 500 basis points. Does it really impact inflation? And I would argue at a certain level, it actually maybe is actually helping keep inflation high.
So that's his point now. It's like, look, we don't need to cut it all the way, but give us a percentage point. So I think if you haven't understood what I've been trying to kind of innuendo-y suggest here, is the fact that this guy wants low interest rates because it's beneficial for his business. BlackRock needs lower interest rates. You don't. This is why I really played the video, was because to show that this is a 4, I think, well, no, longer than 4. This is a like 10-minute video, 6-minute video of him advocating, let's cut interest rates because it will be good for the consumer. Do you honestly think that one of the guys at BlackRock, he's not the CEO, but he might as well be, would be advocating for a policy that would be disadvantageous for him? Your needs and the billionaires' needs do not align. So if the billionaire is asking for a cut in interest rates, you should probably be advocating for a rise in one. That means their business is suffering because of it. But it doesn't, even though you may be saying I'm not thriving because of it, I don't think you'd be thriving in an economy where interest rates are cut. That was the primary reason I wanted to illustrate that video. So it's a 6-minute long video about how we should be cutting interest rates and how it's actually causing inflation, which makes 0 sense at all. Since interest rates have been raised, rents have been dropping, the housing market has slowed down. And if we open up interest rates, that's just going to accelerate. Not to mention they'll be able to both borrow money and lend money at much lower rates, which helps them but does not help us. That fuels Silicon Valley. That fuels big business. It does not fuel Main Street. That's pretty much it. That's my rant. I hope you guys have a great day. I'm already late for work, so I'll see you guys probably tomorrow morning. Take care. Bye-bye.